Thanks for joining us today for Car Chat with the Cannons. Today we're going to talk about real estate.
Yay!
To start it off, Austin has some questions.
I do. So I was looking at a listing the other day that said seller financing. I was hoping you could explain what properties that works for and what does it mean.
Yeah, so seller financing is basically when the seller decides to become the bank on the property. So usually that means that they own the property outright with no underlying mortgage, and they decide to offer a loan with the house as collateral to the buyer of the property. Now, houses that this may work for in particular are sellers who have a certain price that they're hoping to get for their property, and maybe it's not something that is happening on the traditional MLS process. Another type of seller who may benefit from seller financing or may want to offer seller financing is someone who has a tax advantaged reason to do so. So this particularly could mean that the seller has a large tax bill and they will be utilizing seller financing as an installment sale. That will help them avoid paying all of their taxes on the sale right away.
So you said they act as the bank. Does that mean they're giving you or as the buyer, you're getting a mortgage essentially from them and you're paying them, or is that right?
Yeah, so one of the coolest things about offering seller finance is you end up actually getting more for your property than you would if you sold it traditionally. Because if you sell it traditionally, let's say your house is going to sell for 500,000, you collect the 500,000 because you own the property outright, so you get that check, and then that's it. One of the coolest things about seller financing is you have the opportunity to end up making more money from the sale of your property than you would had you just sold it traditionally. So let's say that you own your home outright and you want to offer seller financing. When you offer your property for 500,000, not only will you get that full 500,000, but you'll also get some interest. So it gives you an opportunity to make significantly more money by offering seller financing than you would otherwise.
So what's a typical interest or down payment for seller financing? Can it be anything?
Yeah, so that's one of the most amazing things about seller financing is the terms are all up in the air and can be decided to best work for everyone, so both parties, right? So there have been seller financing deals where a lower down payment is actually better for the seller because of tax reasons. They don't want to take in a large chunk of money, but they would rather have a little bit higher payments over time. Additionally, sometimes people prefer higher payments. So let's take that same $500,000 house that we utilized as an example beforehand. Maybe instead of that you are locked in for that extra amount of money and deciding on an interest rate up front, you say instead, actually, I want to sell my house for 530,000. So just take principal only payments from there. So that prevents somebody from, say, buying the property at 500,000 and then turning around and selling it 6 months later, causing you the tax problems, and you don't end up making the money that you thought you were going to.
So the listing I said there's a balloon, and I assume it's not like a birthday balloon. What is a balloon?
Balloons and seller financing are for clowns. Just kidding. So balloons are something where the entire remainder of the mortgage is due at that period of time, or the loan is due at that time. So for the example previously that we utilized with a $500,000 house, let's say you put $50,000 down, that's a $450,000 loan. And let's say you paid it down now $20,000. So you owe $430,000 on this loan. And now the balloon is due. So you will owe the seller $430,000 at that time. Now, obviously, that's a lot of money, and you don't have to write a check for that. Instead, you would need to get additional new financing. So you would do that via a traditional loan or potentially a private lender.
So when the balloon is due, that's when the remainder of the loan is due.
That's when the remainder of the loan is due to the seller, but that doesn't mean that's when you have to come up with a check. You could sell the property, you could get a new loan. There are a lot of options.
Okay. So how is the seller finance thing different than subject to?
So seller financing and subject to are very similar, but there's a few key differences. Seller financing is typically when the seller owns the property outright. However, subject to is when there is a mortgage in place. And so the person who is buying the property will take the property over subject to the existing mortgage. That means they leave the mortgage in place, and now they will be making the monthly payments on the mortgage instead of the previous seller.
So kind of like you're assuming the loan, essentially?
So subject to is similar to assuming a loan, but there's a few key differences there as well. When you do a mortgage assumption, this can be done on FHA loans, VA loans, and USDA loans, but it can't be done on conventional loans. And another key thing is you have to be the owner occupant. So you have to be moving into the property to occupy it yourself. So if it's going to be an investment property, obviously you would not qualify for a mortgage assumption. It's a really key differentiating factor here because a lot of people utilize subject to because they want to utilize the property as an investment. So it is a similar concept where you will be taking the mortgage over, but you won't be qualifying through the bank and you actually won't be talking to the bank at all or letting them know.
So if you're not talking to the bank at all, how do they find out, or what do they think about this deal?
So the banks can find out, and one of the main ways they find out is when the insurance changes. So you want to be very careful when you're changing the insurance over. Once you purchase a property, you want to make sure that you do it correctly. You do need to change the insurance, but you want to make sure that you do it correctly because that's one of the key ways that they can find out. When they do find out, and if they care, they don't always care, there's something called a due on sale clause. And what that means is that all the remaining amount of the mortgage that's left is due because the person sold the property. So they could give you, let's say, a 90-day time frame to pay off the remaining amount of the mortgage at that time.
So is that due on sale clause? Is that very common to run into that problem or no?
So the bank utilizing the due on sale clause is not very common at all, probably a couple in 1,000 that this happens for. There are some things that can make it more likely that the loan is called due. One of those is not doing your insurance correctly. That would certainly be a reason. Another reason is potentially if there is down payment assistance or some sort of additional help that was done on the property, that can alert the lenders that and that can make them call the loan due. The due on sale clause is really, if you sell the property and leave the mortgage in place, it's a breach of contract, but it's not illegal. It's just something to know. And there are a few ways that you can mitigate the due on sale clause. You could deed the property back to the seller and do a lease option. You could potentially offer contract for deed. You could sell the property or you could refinance the property. Awesome. Well, thanks so much for chatting with the Cannons.